Hello, welcome to Al Stock Trades. I hope you're having a wonderful, happy new year, and I hope 2023 comes off to a better start, especially when it comes to the stock market. As we know, we've had one of the worst stock markets since 2008. Okay. So if you're definitely feeling the bind on your portfolio, if you haven't doubled down on energy or other sectors that have increased during this time, then I understand your pain. In this video, we're going to go ahead and take a look at the free cash flow estimation for United Healthcare. And we're going to essentially show how and why I'm able to estimate the future free cash flows of a company while they're negative free cash flow. We're going to go ahead and take different sorts of estimates, and we're going to go ahead and calculate the intrinsic value for Clover. So from this here, we're going to, without further ado, we're going to go ahead and take a look at this Excel spreadsheet. This data was received from our proprietary brain machine, which is part of our All Stock Alerts and Mastering Stock Market course, lifetime access, which you can find in the link down below. We have a New Year's holiday, New Year 400, which gives you $400 off. There'll be a link down below if you guys are interested. It will be expiring January 3rd. So in any case, this is our brain machine, and we were able to essentially get this data and send it on over to an Excel spreadsheet, which allows us to essentially do data-driven analysis without any emotions, so we can eventually make money in the market here. Happy New Year. Happy New Year. So what we're going to do is, this is the information for United Healthcare. So what I did is I stripped the revenue and the free cash flow, and then I went ahead. We'll make this 0 for now, so we zero these out. So you know how when we do and calculate an intrinsic value calculation for Clover, we take 5% of the revenue. So what I'm going to do here is I'm going to do 5% of the revenue for United Healthcare. Now, you might think this is pointless because we already know the free cash flow, but it's to prove a point, and it's to prove an interesting, overwhelmingly positive point. So if we do 5% here, and we kind of go line by line, in 2012, 5% of the revenue would give about $5.4 billion, when in reality, they made $6.08 billion. So what I'm going to do is, this is reality. So we're going to make this green. Green is reality, okay? And let's go ahead and zoom in, and we're going to make it a light green so you guys can see a little better. I think that'll be a lot better, okay? And we're going to go ahead and see if we can, yeah, good, okay. So if we do 5%, we can see on average, United Healthcare has done more than 5% on average if you compare. In fact, as it goes up, and as you go up the years to 2020 to 2021, you can see that 5% becomes obsolete, especially here. You can see that United Healthcare just drastically started to improve. And 5% is only literally half of its free cash flow when in reality. So 5% of the revenue of $313 billion only gave us $15 billion, when in reality, they made $31 billion. So it's more like 10% of the revenue gives you on average. But you can see, though, in the beginning, United Healthcare only was at 5% of the revenue. So what's the point of this? And why am I doing this? Well, it's very clear. United Healthcare in 2012, it was essentially working towards generating a successful business, improving its gross margins, and little by little, tick by tick, 10 years later, 2022, United Healthcare now sucks more of its cash and is allowing it to go on free cash flow. Essentially, they have become a more efficient business, but it's not just that. More Americans and the world are aging. Kind of a sad note, if you ask me. But it's becoming, I guess, a tailwind for these healthcare stocks. They are going to be doing well in the next 10 to 20 years and beyond. We're going to have a tremendous aging population, and these healthcare stocks are essentially going to be the bucket that will essentially take advantage, sadly, of this transfer of age, to being 60, 65 with all the medical chronic conditions. So it's definitely a sad topic, but if we don't discuss it, then it's we kind of do a disservice to our members and our subscribers. So in this regards, and this is just a 10-year analysis. If we go ahead and look at this is only 10 years, guys. If we were to go back, and we can do this, go back to 1995, 2000, and 2005 with United Healthcare, it would be interesting to see what is the revenue, right? Is it going to be 5% of the revenue for the estimating of the free cash flow? Or would it have been lower, 2%? So on average, it's 5%, right? Which is why I do 5% of the free cash flow, because if you look at it, it underestimates the reality. And that's the whole point of what we're trying to do. We're trying to underestimate reality. But overall, if you analyze how Clover Health has grown in comparison to United Healthcare, there is a slide that it's part of their investor relation page, and we've talked about it before in the channel, God knows when, in all the videos that we created. But it's very clear that Clover is growing faster than United, and they have the Clover Assistant, which allows them to essentially generate a higher gross margin than the average incumbents. So if you analyze that, and if you were to apply it, then perhaps with this tailwind heading towards this increasing, aging, diverse population, Clover Health is going to drastically increase, and I believe bump up this revenue estimation of the free cash flow to 10%. But what we're going to do is we're going to do a 5% calculation, an 8% calculation, and a 10% calculation based off of the revenues for Clover Health in this intrinsic value. But before, I wanted to show you something really interesting in our proprietary brain machine software technology that has data centers directly in Wall Street. We're going to go ahead and we're going to do an intrinsic value calculation automated for United Healthcare. If you go ahead and do an advanced leverage DCF projection, all you have to do is just put in the ticker symbol, UNH, okay? And you go ahead and click it, and what it does is it goes 2024, 2026, 2025, I can't count, 2026. Anywho, it goes and it basically gives you that the equity value per share should equal $545. That is how much United Healthcare is worth. So you go in, and I didn't even look at the stock price. It's trading at 530. So essentially right around the ballpark range of how much it's worth. In fact, if you go ahead and do the other calculation that we have multiple types of DCFs, you can, and again, this is all included in the subscription model and lifetime access as well for people that are interested. Let's see. I did the AL DCF. Let's just do the advanced DCF, UNH. And you could see 585. That's how much it's worth. And has it even ever reached that before? Yeah, just around just a 558, right? So overall, there's a lot of also hedge funds that own the stock now. They're doubling down. But overall, if you look at the stock price, you can see from 2012 and then on, it took how many years to increase? How many years did it take them to increase? Literally about what, 16? Oh no, is that 1,000%? About, yeah, around 16x. So as you can see here, it took so long for them to get to that price and to get to these types of values. Okay, so now what we're going to do is we're going to do an intrinsic value calculation, and we're going to do a 5% estimation, an 8%, and then a 10%. So overall, we're going to go ahead and we're going to just use $2.3 billion. We know they're making more this year, but I believe they're going to decrease their revenue in order to remain profitable, because that's what the market wants now. And later, when we get our recession and unfortunately people suffer, I'm sorry, it's terrible, but then interest rates will be 0%, and then Clover can turn on the growth machine. But right now, we're just going to do $2.3 billion. In fact, while we do this, I would honestly also like to open up another menu off of our mastering, and I would like to do a revenue analysis projection. So if we could just do this really quickly, if we can put an estimated revenue of 2.3 billion, and we'll grow this at 25%. So we can see that by 2025, they should technically have around 4.4 billion on average. And again, we're undervaluing this too. So about 4.4, I would say around 3.5 to 4.4 billion. We'll call it 4 billion. So we'll do a couple different types of calculations, one with 2.3 billion and the other one with 4 billion. So again, like I said, we're going to have different types of revenue calculations, 5%, 10%, sorry, 8% and 10%. So we're going to go ahead and do this. Okay. And all I'm going to do is I'm just going to change this number. It's just going to make it easier so we don't waste time here. So on average, we're going to have 115. So this is kind of like the low ballpark here, okay? So we'll do 115. We're going to shoot this out to 10 years, and we're going to have them grow again, 2032, and then going back to today's present value. We're going to have them grow at 25%. So if they grow more than that, then we're definitely going to be excited. 477, we'll just leave it at that. So this is the price. Anywhere between $4 is a recession, which we know that it's way lower than that. So even on a recession base, 828 for the bear, 11 for the base, and 16 for the bull. So if we were to go ahead and put the 4 billion, which is 200 million cash flow, we go anywhere between 7 recession, 14 bear, 19 base, and 28 bull. Now, what's interesting, though, if we go ahead and do the 8%, which I guess we could say the ceiling is 10%, right? If we do that, we can go ahead and go back to 2.3 billion, which was 184. That's anywhere between, I would say recessions don't come too often. So I would say let's look at the bear. I only added this here because we're going into the recession now, so might as well. 13 to 25. Okay, so $13 to $25. But that's just the bearish sense. If we have 4 billion and we do 4 billion in 2025, we'll have a free cash flow of 320. And you could see the stock price. You could see like how unimaginable this. I mean, you might, in the stock market, it gets you into a bind where you start, having denial. Like, yeah, right. I don't believe this. But if you go ahead and take a look at a couple stocks that we spoke about here, I mean, this was trading at $2 AMD, and then it went all the way as high as $154. Okay, so this was $1.87, and then here it went up. And if you don't think that's impressive, or you're like, oh, that's just AMD. If you look up Enphase did the same thing. Enphase was around $2, and then it went up 14,000%, almost 15,000. Right. So this is how the market works, and it's literally a transfer of wealth. It's a transfer between the impatient to the patient, right? And this is exactly what we like to preach to all of our members. I'm very proud of us. By the way, for all of you guys that are watching, thank you for participating in our monthly meeting. A lot of you guys are going to start meeting weekly on our private group, utilizing the data, and I can't wait to see what you guys come up with. But overall, it's literally the transfer between the impatient to the patient. So that's kind of how it seems like, right? And we're getting into the 30s and 40s here, right? And if they continue turning, let's say, for example, and at the time when I'm talking about in 2025, 2026, a lot of these new investors are going to come in the market. They're going to get excited. They're like, oh my God, free money. And they're going to just pile into the stock. And then if Clover decides to turn on their growth machine and all of a sudden they grow at like 40%, we can see a stock price. So let's say they do their 80% that they've grown. You could see the stock price starts going into just insane, parabolic. But it's going to be hard to grow from 4 billion. I would say if they do 50%, or even 45%, you can see how parabolic this can get once easy money once the money printers start turning on, and once we get to that recession and we get to that zero interest rates, right? So you can see here how impressive this is. And this is why, this market and this stock has been attacked, right? The whole point was to get retail investors out of the market for COVID, to kind of scare them really badly. But the problem is, hedge funds and a lot of these folks, they misinterpreted what would happen if you just put a bunch of Americans at home and the rest of the world at home. What are they going to do? They're looking at the stock market going up to insane highs. Of course, they're going to pick up their phone and start trading, right? So overall, what we need to happen, sadly, is we need, sadly, to have a bunch of retail investors sell. There's a lot of retail investor ownership in the stock right now. And it's this type, it's kind of almost like a Tesla, if you might say. A lot of them, if you look at the ownership for United Healthcare, it's owned majority by hedge funds, right, or institutions, right? And the goal is essentially to get all this fast money out. There's a lot of fast money. There's a lot of like dumb money in Clover. Sadly, I mean, it is what it is. There's a lot of dumb money in Clover, and the goal is essentially to remove these folks, so these price fluctuations are essentially going to be stabilized. So what's going to end up happening is they're going to, I think they're going to drop it even more. Let's say if there is a recession. And once it gets to like, a good amount of money, $4, $5, $6, and once it hits 15 or whatever, a lot of investors are most likely going to sell. And like, oh my God, thank God I broke even. Or, oh my God, I'm happy with this. I'm done. I'm done with the stock market. Oh, no more. And then they're going to essentially buy in at it and get all their shares, their valuable shares, right? And then it's going to be very interesting. And then you're going to see a whole new set of retail investors come in. Wow, Clover's amazing. It's about to squeeze, and it's like literally at like 30, $40. It's about to squeeze, and then don't, you're a FUD. You're a FUD if you don't, all that junk, right? And once a stock hits its intrinsic value, it hits its intrinsic value, right? So that's kind of all I have basically to say in regards to this. Again, if you enjoy this content, please like, as it does help with the YouTube algorithm, and please subscribe to our content, as it really does help spread the word about how essentially, a lot of hedge funds and a lot of fundamental and value investors calculate intrinsic value calculations. Likewise, we do have a sale New Year for 100. There'll be a link down below. This sadly will be the lowest price that you will see these courses and these lifetime access be. We will be raising our prices after the January 3rd expiration from the coupon code link that gives you $400 off. So without further ado, it's a privilege and honor, and I will see you on the next one.